Everyone, welcome back to Books and Backbone. My name's Donna Harris. I'm the CEO of Bookkeeping Made Simple, and I am your host for today. Today I'm going to kind of tell you a story. It's not a dramatic story. It's not a complicated one. It's not dramatic, at least not on the surface. Just a quarterly review call. It started like every other quarterly review call I've ever had. And then it didn't. And I want to tell you the story because it's one of the clearest examples I know of the thing that sets a bookkeeper who maintains your records from one who actually understands your business. And when I get to the end of it, I think you're going to hear something different than you'd expect. Okay? And yes, I'm vain. That's why I keep taking my glasses on and off. I hate to admit that I don't see very well to read. It's a bummer. We were doing a quarterly review. Okay. Client I've been working with for a while, good business, consistent revenue, nothing unusual on the surface. We're going through the year category by category, the way I always do it. Revenue trends, expense categories, cash position, accounts receivable. Normal call, nothing to make me sit up straighter and pay attention. And then something happened in the middle of it. Not at the beginning, not flagged as important, just kind of dropped into the middle of the call. She said, when my partner took out a $40,000 loan against the business last year. One sentence. Casual. Like, oh, and by the way, I went to McDonald's for lunch. I mean, casual. Not the tone of something that, like, she bought office chairs. I wrote it down. I didn't say anything right away. I mean, what do you say? And then I asked her to tell me a little bit more about it. Well, here's what most people would hear in that sentence. The business took a loan. Okay, businesses take on loans. That happens. Here's where I heard 3 separate problems that weren't showing up anywhere in QuickBooks. Problem 1, the income was overstated. That loan proceeds had been recorded as revenue, which means her profit and loss statement showed $40,000 more income than the business had actually earned that year, which means every single decision she made based on those financials, every assumption about how the business was performing was based on a number that wasn't real. Think about it for a minute. I mean, most bookkeepers, they just say, well, it's a deposit, it must be revenue, right? If you look at the P&L and you didn't know about that loan, you would assume that the business was doing much better than it really was. And she thought the same thing because nobody had caught it. Problem number 2, liabilities were understated. That loan did not show up on the balance sheet. That is a $40,000 obligation to the business, money the business owed, and it's not on the balance sheet anywhere. So it didn't exist anywhere in the financial records. So, any banker looking at this would have thought, the business looks stronger than it really was. Anyone looking at the business would have thought the business, $40,000 overstated income, $40,000 understated liabilities. It looks great, right? Any buyer doing due diligence would have seen a balance sheet that didn't reflect reality. And a partner trying to understand the financial position of the business would be working from incomplete information. That's not a small problem. That's misrepresentation. It's unintentional, but it's real. Problem 3, partner's equity was distorted. Because the loan wasn't recorded correctly, the partner's equity positions were being calculated on numbers that didn't actually reflect what had happened. One person had effectively taken $40,000 out of the business or borrowed against it in a way that was showing, it wasn't showing up anywhere. It wasn't showing ownership. It just wasn't showing up. Which means if these 2 partners ever had to have a real conversation about what each of them had taken out of the business, the books couldn't support that conversation. One sentence, a very casual sentence. 3 problems, none of them showing up anywhere until someone asked. Here's the part I want you to hear most clearly. She wasn't hiding anything. She wasn't being evasive. She mentioned it in passing because no one had ever explained to her that it mattered. At least not in a way it needed to matter, which is this changes your financial statements. She had a prior bookkeeper. Books were, reconciled every month. File went to a CPA every April. Nobody asked. Nobody caught it. Nobody connected that loan to everything downstream from it. Overstated income, missing liabilities, distorted partner equity. The bookkeeper was kind of maintaining the records. Nobody was understanding what the records meant. And, this is the pattern I see more than anything in cleanup and forensic engagements. The things that change your financial picture, that make your income look different from what it is, that change what you owe, what should be coming in, what your revenue is, affect what each partner is actually taken out of the business. These aren't the things clients lead with. These are things mentioned in passing because they just feel like logistics. They're administrative details. It's no big deal. It's relevant to someone else's job, not the conversation we're having right now. A loan, a piece of equipment traded in, a family member added to payroll, a distribution from the business that got coded as an expense, a side gig that got paid cash. These details feel small. They're not small. After 25 years of doing this work, I've come to understand something about the way information moves between a business owner and their bookkeeper. Most clients tell me what they think I need to know. Oh my gosh, I cannot even tell you. Which is almost never the same as what I actually need to know. It's usually not because they're withholding. Usually. Because they don't know what they don't know. They don't know that the way a loan gets categorized changes their profit and loss. They don't know that a partner distribution needs to show up on the balance sheet. They don't know that the casual detail they just mentioned in passing is the one I most needed to hear. And that is why bookkeeping is not just a data entry function. A bookkeeper is only looking at the categories, at the transactions, is going to miss everything that happens in the space between the transactions and the business events that created them. That $40,000 in the books wasn't in the books as a loan. It was in the books as revenue. And if you're not asking what that revenue is, if you're not connecting the numbers to the business events behind them, you're going to maintain a clean-looking set of records that tells the wrong story. The $40,000 wasn't the problem. Books that didn't reflect reality were the problem. And reality had been sitting in the middle of a sentence, in the middle of a quarterly review call, waiting for someone to ask about it. I tell this because I want you to think about the conversations you have with your bookkeeper, not the emails asking for bank statements, not the monthly reconciliation, the actual conversations. Does your bookkeeper ask you about your business, not just your transactions? When something unusual happens, a loan, new partner, piece of equipment, a change in how you're taking money out of the business, do you know how to tell them? Do you know to tell them? Do they know to ask? Because the gap between what you tell your bookkeeper and what they need to know is where problems live. And they don't surface at reconciliation time. They surface at tax time, at loan application time. At the moment you're trying to sell your business and a buyer's accountant goes through 3 years of records and finds a $40,000 liability that doesn't exist anywhere in the books. Your bookkeeper should know things you don't know to tell them. That's not a magic trick. That's what the quarterly review is for. That's what the right questions are for. That's what 25 years of pattern recognition looks like in practice. Now, if you have a loan that wasn't recorded correctly, I promise it's not as catastrophic as it sounds right now. These things are fixable. Clean books can be rebuilt. Financial statements can be corrected. The story your books tell can be made to match the story your business actually lived. But you need someone who's going to ask the question, who's going to hear the sentence in the middle of the quarterly review and write it down, who understands the casual detail is almost always the important one. If that's the conversation you want to have about your books, about what might be in them that nobody has asked about yet, I'd love to talk. You can find me at mysimplebookkeeping.com. The consultation is free for now. That may change. You can go to mysimplebookkeeping.com/contact and make an appointment directly with me. The clarity is worth well more than the consultation. I'm Donna Harris. This is Books and Backbone. Thank you for listening. And if this episode made you think of something in your own business that you haven't told your bookkeeper yet, that's probably the place to start. And if this was worth anything to you, please like, share, and subscribe. And if you're on YouTube, hit the red notification bell so you can be alerted when we upload new episodes. Talk to you soon.